You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Okay, let's jump right in. We're doing a focused deep dive today, looking at the big forces, shaping the markets right now.
Yeah, FX, commodities, trade, geopolitics, the whole mix.
Exactly. And we want to distill it all down, give you what you need to know just before the U.S. session gets going.
Kind of a shortcut to getting up to speed, basically.
That's the mission. Cut through the noise, find the key trends, see how everything's connected, especially what's driving asset moves this morning.
And the big picture hook, I think the main story as New York wakes up, it's really dominated by this softer U.S. dollar.
Definitely. It's sliding again today.
Second day now. And that's really the engine, isn't it? It's pushing gold up to, well, some pretty dramatic new highs.
Well, all that trade and geopolitical stuff keeps simmering away in the background.
Exactly. Never quite goes away.
So that softer dollar is the big headline. But, yesterday's U.S. labor data, it seemed pretty steady.
It was, relatively speaking.
So why is the greenback falling? What's the specific signal driving this weakness right now? Is it policy?
It's interesting. It's less about today's data and more about looking ahead. It's a hint about a policy pivot, really.
Okay.
It follows Chair Powell's recent comments, his reminder that the downside risks to jobs, well, they've risen.
Ah, right. I remember that phrase.
And the market's latched onto that specific language. The interpretation is that maybe policy normalization, especially the Fed shrinking its balance sheet, that balance sheet runoff, that process might be nearing an inflection point.
Okay, wait, let's just pause on balance sheet runoff for a second, just so everyone's clear.
Good idea.
When we talk about that, we essentially mean the Fed is pulling liquidity out of the system, right? Tightening conditions.
Precisely. It's a form of monetary tightening.
So if the market thinks the Fed might pause that runoff or slow it down, what does that actually mean for the dollar, fundamentally?
Well, fundamentally, it signals that maybe the period of, let's say, maximum liquidity tightening could be ending sooner than people thought. Yeah. And the dollar, it tends to thrive when U.S. policy is much tighter than elsewhere, that policy divergence idea.
Okay.
So if the market starts pricing in even a small chance, the Fed might ease back on the throttle, take their foot off the gas a bit.
Yeah.
That erodes that whole higher for longer rates story, and that's inherently negative or bearish for the USD, which is why we're seeing it slide.
Makes sense. And looking across the pond, the euro is clearly liking this dollar weakness. It's moved back above 1.16 pretty comfortably.
Yeah, back in familiar territory there.
Does that move need some sort of domestic strength to really stick, especially with all the recent worries about European politics?
It certainly helps. And you're right. The euro's resilience here is definitely tied to politics calming down a bit in France.
What happened there?
Well, the government suspended that really controversial pension reform plan.
Okay. That was causing trouble.
Big trouble. And maybe just as important, the main opposition, the socialists, they signaled they won't join any immediate efforts to, bring down the government.
So less near-term political chaos.
Exactly. Less uncertainty, especially in a core Eurozone country like France. That takes a big risk factor off the table and lets the euro strengthen naturally against that weaker dollar.
It's always amazing how quickly stability, or even just less instability, in Paris translates to currency moves.
It really does. Meanwhile, over in the UK, sterling seems to be steadying itself after that little wobble it had with its own labor market data.
Yeah. What's keeping things stable for the Bank of England story?
Governor Bailey helped out there. He gave the market the narrative it needed.
How so?
He basically said the recent data fits with the picture of a cooling jobs market, which for the UK right now is actually what the BOE kind of wants to see to get inflation under control.
So no big surprises.
Right. By sticking to their data-dependent stance and confirming things are cooling as expected, he basically signaled no sudden, unexpected policy shifts are coming. That gives the pound a bit of steady ground.
Okay. Let's pivot again maybe to the yen, the safe haven yen. It's looking quite firm.
Holding its ground.
Which usually signals there's still some risk aversion floating around. We saw USD-JPY dip towards that 151 level, didn't it, before bouncing back a bit?
Yeah, it flirted with 151.
Why is that 151 level significant, and what's actually driving demand for the yen right now?
Well, the yen's getting a boost from two main things at the moment. First, there's that lingering safe haven demand tied to the geopolitical stuff we'll get to in a minute.
Right.
And second, it has that inverse relationship with U.S. rate expectations as the market dials back how aggressive it thinks the Fed will be.
The interest rate difference narrows.
Exactly. The rate differential narrows, which makes the yen relatively more attractive. And as for a 151, well, that's become a really key level technically and psychologically.
Like a line in the sand.
Sort of. When the price gets near there, a lot of traders who follow long-term trends start watching very closely. They're deciding if a bigger reversal is happening or if it's just a pause.
So the dip and bounce suggests?
It suggests that while the dollar is weaker, the market isn't quite ready to bet everything on a huge yen rally just yet. There's still some caution.
Okay. What about down under? The Antipodians, the Aussie and Kiwi dollars. The Aussie dollar seems to be leading the pack a bit among the G10 currencies this morning.
Yeah, modest gains, but leading nonetheless.
What's giving the AUD that little bit of an edge?
It's a couple of things coming together. Domestically, you had officials from the Reserve Bank of Australia noting that Q3 inflation risks might be skewed just a little bit higher.
Ah, so hints of stickier inflation.
Just hints. But any suggestion of persistent inflation down there tends to give the Aussie dollar some underlying support.
But there was something else, too. You mentioned cross-market support.
Right. The really critical piece, I think, came from China.
Ah, the China connection. Always important for the Aussie. How did that play out?
Well, we saw a firm PBOC fix. The People's Bank of China, they set this daily reference rate for the yuan, right?
Mm-hmm. The midpoint.
And when they set it firmer than the market expects, like they did, it sends a signal. It shows they're committed to keeping the yuan stable.
Which reduces worry in the region.
Exactly. It helps calm regional volatility. And because the Aussie and the Kiwi dollars are often seen as proxies for, global risk appetite, and especially for Chinese demand.
A stable yuan helps them too.
Precisely. That firm fix lent support to the yuan itself, and that support kind of radiated outwards to the AUD and the NZD as well.
That's a really good picture of the currency landscape. You've got Fed policy hints, European political shifts, Asian stability signals, all feeding into these moves.
It's all interconnected.
Okay, let's switch gears then. Let's talk commodities. You said earlier the market's clearly split, and gold is definitely the star performer. It punched right through USD 4,200 an ounce.
Yeah, quite a breakout. Really a significant move. And it's being fueled by that classic combination, what you might call the perfect trifecta for gold.
Okay, lay it out for us. What's the trifecta?
First, the softer dollar we've been talking about makes gold cheaper for buyers using other currencies. Simple as that.
Right. Factor one, weaker dollar.
Second, those lingering expectations of policy easing, tying back to Powell's comments, that reduces the opportunity cost of holding gold, which, doesn't pay any interest.
Okay. Factor two, lower rate expectations. And the third factor must be that risk premium, right? Geopolitics.
That's it, exactly. The third leg of the stool is the geopolitical situation, which is still very much active, maybe not exploding, but busy.
So big players are hedging.
Institutions, central banks,
Yeah.
They use gold as a core risk hedge. And with these persistent sort of low-grade international tensions, they can't really afford to fully unwind those hedges.
Keeps demand solid.
Keeps demand solid and puts a strong floor under the price. Hitting $4,200, it really confirms the market is taking both those risks, the policy uncertainty and the geopolitical stress, very seriously.
Okay, but then you look at oil. It's just drifting, stuck in tight ranges. Usually oil jumps on geopolitical risk, but it's not really following gold here.
No, it's not showing the same kind of excitement, is it?
Why the disconnect? Why isn't oil surging too?
Well, oil traders are doing this really careful balancing act right now, and that's keeping things pretty muted.
Balancing what?
On one hand, yes, they're absolutely looking at the headline risk from the Middle East that normally supports oil prices, potential supply disruption, and all that.
But on the other hand?
On the other hand, the demand outlook has been looking a bit softer. We've had recent projections from energy agencies suggesting maybe slower global growth ahead.
And trade friction doesn't help demand either, I guess.
Exactly. Those ongoing trade frictions, which we'll get to, cast a bit of a shadow over industrial demand, manufacturing demand. So oil is kind of stuck between the fear of a supply shock and the worry about a demand slump.
Makes sense. We're also seeing copper looking choppy. It recovered some ground after Tuesday's dip, but you mentioned it's still very sensitive.
Yeah, copper is like the classic canary in the coal mine for the global economy and trade, isn't it?
The PhD in economics, they call it sometimes.
Right. It bounced back a bit, mainly helped by the weaker dollar making it cheaper, but it's definitely volatile.
Why particularly sensitive right now?
Because any whiff of new trade headlines, especially negative ones, directly hits expectations for manufacturing, for construction, the things that use a lot of copper. Its choppiness really reflects just how uncertain that global industrial outlook feels right now.
Okay, that's a perfect lead in then. Let's talk trade and geopolitics directly, because the rhetoric on the surface seems to have eased slightly.
Yeah, a notch maybe?
We heard China's foreign ministry saying the U.S. and China should, engage in talks. That sounds constructive.
It sounds constructive, but you always have to look below the diplomatic niceties, right? The underlying fault lines are still very much there.
So actions speak louder than words.
They absolutely do. And we have to focus on the concrete actions, not just the soothing language. The clearest example of friction today. China's just filed a WTO complaint against India.
Okay, against India. Over what specifically?
Over India's subsidies for electric vehicles and batteries.
EVs and batteries again. Seems to be a recurring theme.
It's central. And this isn't just some minor technical dispute. China explicitly vowed resolute measures to protect its own domestic industry. That's strong language.
Okay, but why should someone, say, trading the U.S. market, care deeply about a trade spat between China and India over batteries? What's the ripple effect?
It's critical because it shines a spotlight, forces sustained market attention onto supply chain policy, especially in these really crucial sectors. Autos, batteries, critical materials.
So it's bigger than just India and China.
Much bigger. This dispute highlights the intense global competition that's underway for dominance in the future of transportation, future of energy. The fight over Indian subsidies is really about who controls the next wave of battery manufacturing, who controls the sourcing of essential minerals, and that directly impacts major companies and strategic interests in the U.S. and Europe, too.
So it's not just about tariffs anymore. It's about deeper industrial strategy. Who gets the edge globally?
Exactly right. And it raises this really important question for the market. How will the responses, the remedial steps taken, whether by China, India, the U.S., the EU, how will those steps eventually filter into what we call relative terms of trade? Meaning how the price of a country's exports compares to the price of its imports. If one country uses subsidies or tariffs to make its stuff cheaper or foreign stuff more expensive, it fundamentally changes the economic calculus.
And that can impact currency valuations.
Absolutely. It has direct consequences for currency moves and global capital flows. It's a slow burn, but it matters.
And this backdrop of trade friction, supply chain competition, it feeds right back into that geopolitical premium we saw boosting gold, right?
Definitely.
You described the geopolitical tape as active but uneven. It feels like the world isn't necessarily on fire, but there's certainly no real stability either.
That's a good way to put it. Fragile.
What are the specific, maybe nuanced details that are keeping that sort of fragile calm in focus, preventing things from either getting much worse or much better?
Often it's the small logistical things that signal the real temperature. For instance, today, officials indicated the Rafah crossing wouldn't reopen just yet. Logistical checks were cited.
Okay.
A delay.
A delay.
Separately, you had Israeli media reporting some questions, some uncertainty over the identification of one of the bodies that was transferred as part of the hostage process.
Right, okay. But why does a logistical check at a border crossing, or a question about identifying remains, why does that matter to a global macro trader looking at gold or the dollar?
It matters because these details prevent the market from fully committing to the idea that stability has returned.
Okay.
If the Rafah crossing just opened smoothly, if the hostage process proceeded without any hitches, maybe the market would feel confident enough to start selling off those geopolitical risk hedges more aggressively.
But these little friction points keep the doubt alive.
Exactly. These small, persistent issues, the logistical snags, the confirmation delays, they maintain that sense of fragile calm. They ensure that the geopolitical risk premium stays embedded in assets like gold. It keeps the possibility of things escalating quickly still on the table,
Understood. Okay, one last piece before we pull it all together. We've got a pretty heavy calendar of central bank speakers coming up during the U.S. session today.
Yeah, packed schedule.
That could potentially fine-tune all these expectations we've been discussing.
For sure. You've got key figures from the European Central Bank speaking. You have a whole sleet of different Fed officials lined up, and everyone will be listening closely to see if they echo Powell's recent tone or maybe push back slightly.
And the Beige Book later, too.
And the Beige Book, right. Which, for listeners, is the Fed's own qualitative report card on how the economy looks across the different U.S. districts.
So lots of potential new inputs.
Lots of inputs. And all of them will be scrutinized really carefully for any clues that might adjust those rate path expectations, the same expectations that, as we've said, are already pushing the dollar lower.
All right, time to consolidate. Let's wrap up this deep dive. The clear market story heading into the New York Open seems to be a noticeably softer U.S. dollar.
Definitely the headline.
And that's fueling a stronger euro and a firmer yen. Gold is hitting fresh highs,
buoyed by those policy hints and the geopolitical risk premium.
while oil is just treading water, really caught between the supply risks and those softer demand forecasts.
And simmering underneath, that trade friction, particularly around strategic sectors like EVs and batteries, is quietly heating up.
So you're looking for the next directional nudge, the next catalyst. Where should you be focusing your attention immediately?
Okay, I'd say 3 key areas to watch closely today. First, the actual substance of those upcoming remarks from Fed and ECB officials. Do they double down on the recent messaging, or do they offer a different nuance?
Okay, central banks speak. What else?
Second, keep an eye out for any concrete follow-through actions or statements related to China's WTO move against India. Does that escalate? Does it stay contained? That tells you about those supply chain tensions.
Got it. Trade developments.
Yeah.
And third.
And third, just monitor the implementation details around the Middle East situation. Are those logistical hurdles, like the Rafah crossing, getting resolved, or do they persist? That sets the tone for geopolitical risk.
That definitely covers the immediate horizon. But let's just take one step back, connect this to the bigger picture for everyone listening. What's the key takeaway or thought to carry through the day?
Well, think about this interconnected risk we've mapped out. Right now, you have 2 primary drivers pushing gold higher and the dollar lower, working in tandem.
Okay.
On one side, you have hints of policy normalization potentially slowing down, driven by Powell's comments. That's the domestic monetary policy angle.
Right.
On the other side, you have these persistent, immediate geopolitical concerns, mainly from the Middle East. That's the international risk-off angle.
So monetary policy and geopolitics pointing the same way for now.
Exactly. They're both supporting gold and weakening the dollar simultaneously. So the provocative thought is, given that these 2 powerful forces are aligned right now, how incredibly sensitive might the market be if there's an unexpected sharp shift in either one of them?
So if the Fed suddenly sounds much more hawkish again.
Or if, conversely, there was a sudden credible breakthrough towards calm in the Middle East.
The reaction could be quite sharp, because both supports would be questioned at once.
Potentially, yes. That dual pressure converging like this makes the current markets quite potent, but perhaps also quite fragile. It's a massive consideration, I think, for pretty much every asset class as we move forward.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.